Hey guys, welcome to StockSkope. Today we are going to talk about one of India's most loved retail success stories. Yes, Trent Limited. The stock has just crashed over 7.45% in a single day, hitting a fresh 52-week low. This is the same Trent that owns Westside, Zudio, and Star Bazaar and operates more than 1,000 fashion stores across 242 cities in India. This company has reported over 17,134 crore rupees in revenue last year with a massive return on equity of 30%. So what exactly went wrong with Trent Limited? Despite reporting 16 to 17% year-on-year revenue growth and an 11% rise in profit, the investors started dumping the stock. Why? Is this a temporary correction or the start of a bigger downfall? Is Trent still the retail growth story of India, or is it now too expensive to own? In this video, I will break down exactly why the stock crashed, how strong the business really is, along with a thorough analysis of the Trent stock so that you can finally decide on whether to buy, hold, or sell Trent at this stage. So come on, let's start. But first things first, why did Trent stock fall by more than 7% in one single day? Yes, on Monday, November 10, 2025, the shares of Trent Limited experienced a sharp decline up to 7.45%. The main reason for this significant drop was the release of the company's second quarter or Q2 financial results. Here is the breakdown of the key factors that caused investors to sell the stock. Number 1, the growth was slower than expected. While Trent's business is still growing, the rate of growth was less impressive than investors had hoped. Trent posted consolidated revenue growth of around 16% to 17% year-on-year, but company was aiming for the growth of 20 to 25%. Next, slow store sales also worried the investors. The growth in sales from existing stores was notably weak, remaining in the low single digits. This suggested that the company's established locations were not drawing significantly more business than the previous year. Another thing, the consolidated net profit for the quarter rose by only 11%, but this was not enough to satisfy the demands of investors who expected much faster earnings growth to justify the stock's high price. Number 2, expansion costs. The company is aggressively opening new stores, including 63 new stores across various brands like Westside, Zudio, and the new brand Burnt Toast in Q2 financial year 26. Expanding into smaller Tier 2 and Tier 3 cities requires significant upfront costs like rent, setting up the store, and hiring new staff, which temporarily reduces the operating profit margin. Number 3, grocery business dip. The Star Food and grocery business saw a temporary decline in revenue of about 2% year-on-year. This was primarily because multiple stores underwent renovations and upgrades during the quarter, affecting their sales performance. But perhaps the most critical reason for the sharp percentage drop relates to how the stock was valued before the results. So number 4, high valuation. Trent stock trades at very high valuation, a PE ratio of about 94. For a stock valued so richly, meaning investors expect phenomenal future growth. Even a small disappointment like missing revenue guidance or seeing margins slip slightly can trigger severe selling pressure. Number 5, brokerage downgrades. The weak results led major financial institutions to revise their outlook. For instance, the brokerage Jefferies lowered its target price for Trent, reducing it from 6,000 rupees to 5,000 rupees. This kind of downgrade further accelerates the negative sentiment and selling. Now, let's understand the business fundamentals and structure of this Trent Limited business. How strong is Trent's business? Even though the stock fell, I believe the company still has some powerful fundamentals behind it. Number 1, the direct-to-consumer model. Means this gives them the full control over product quality, inventory, pricing, and customer experience. Trent runs a D2C model, which basically means the company designs, makes, and sells its own products directly to customers. No middleman, no third-party brands or anything. Everything you see in Westside or Zudio stores is 100% Trent's own brands. They don't sell external labels and they don't depend on outside e-commerce platforms. Instead, they use only their own channels like Westside.com, Tata Click, and Tata knew to sell their products. Number 2, financial strength. Trent reinvests nearly 89% of its profits back into the business to fund expansion. The company is clearly focused on long-term growth, not just short-term profits. You can see it here. Other than this, ROCE is 30.7% and ROE is 30.4% for Trent Limited. Sales growth and profit growth both are more than 15%, and debt to equity ratio is only 0.38, which is much less than 1. Means the company doesn't have much debt. Number 3, Trent's business structure. Now, let's look at what makes up Trent's business. First, fashion and lifestyle, which is the core engine. This includes brands like Westside, Zudio, and newer concepts like Samo and Utsha, catering to every price segment and customer base. Second, food and grocery under the Star brand. This business is run by Trent Hypermarket Private Limited, a 50-50 joint venture with Tesco UK. Star focuses on groceries and fresh produce, and over 70% of Star's sales come from Trent's own private labels, just like in their fashion stores. And thirdly, the strategic partnerships. Trent has 2 major collaborations with Spain's Inditex Group operating Zara India, where Trent owns nearly 34.94%, and Massimo Dutti, where Trent owns around 20%. They also own 51% of Booker India, a wholesale business that supplies groceries and staples to local kirana stores and caterers. In short, from designing clothes to selling them, from groceries to fashion, from Tier 1 cities to Tier 3, Trent is building a completely self-sustained retail empire. So we can say, due to its high valuation, Trent Limited is definitely not a value stock, but its combination with high quality business makes it a good growth stock. The company has great fundamentals, but it is not a cheap buy. Next, future prospect of Trent Limited. Number 1, going 10 times bigger. It's true actually. Trent's chairman has a massive vision. He wants the company to become 10 times bigger in the near future. Since that statement 2 years ago, Trent's revenue run rate has already doubled. The company is now targeting around 25% annual growth, driven mainly by its fast-growing affordable fashion brand Zudio. Number 2, the expansion. Trent's main growth plan is very simple: massive expansion across both physical and digital spaces. Trent Limited is focusing on Tier 2 and Tier 3 cities, as they think the biggest opportunity now lies in India's smaller cities. Customer response has been super encouraging, and Trent plans to double down on this growth wave. Also, Trent is increasing store density in nearby areas to capture a bigger chunk of local spending. And yes, Trent is also expanding abroad. Its flagship brand, Zudio, has started operations in the UAE. Number 3, the growth engines, fashion and grocery. Trent is now broadening its product base, entering beauty and personal care, innerwear and footwear, making its stores more of a one-stop shop. It has launched a premium occasion wear brand, Samo, and in the food and grocery business, the Star currently operates in just 10 cities, giving it a huge runway for future growth. Their goal is to offer great value, trusted quality, and even co-locate Zudio stores with Star outlets to maximize traffic. Number 4, that take advantage. To manage this massive expansion, Trent is going all in on automation and AI-driven systems to handle growth efficiently. It's migrated to a cloud-based system for real-time analytics and smarter decision-making. Also, Trent is boosting warehouse capacity and speeding up deliveries using spiral conveyors and cross-belt sorters. But Trent's ultimate goal is a seamless shopping experience where online and offline stores such as Westside.com, Tata New, Tata Click, etc. work as one, an omni-channel integration. But there are some challenges ahead. Number 1, tough competition. Big players like Reliance Retail and Aditya Birla Fashion are competing really hard. Plus, economic slowdowns or high inflation could hit the demand. Number 2, Trent is also facing talent retention issue. Retail depends on creative talent, and rising costs plus high attrition make it hard to keep top people. Number 3, the valuation risk. Trent is not a value stock at all. It trades at a very high valuations, so even a small earnings miss can cause a big price drop like we just saw recently. So should investors invest, hold or sell Trent stock now? Well, I am considering buying the stock for the long term as I believe the company can sustain its ambitious expansion plans. Despite recent results, the consensus among the analysts tracking the company shows that most maintain a buy rating, around 16 out of 27 analysts as of recent data. But holding the stock is appropriate for existing investors who bought at a lower price and want to wait out the current volatility. A number of analysts, around 5 out of 27 according to Bloomberg data, recommend a hold, suggesting that staying put is a reasonable strategy given the conflicting signals. Trent is no longer a good stock for short-term profits. It is very obvious. It has significantly underperformed the broader market with a negative return of around 32.02% over the last year. So finally, I would say if you want to enter in Trent Limited, you should definitely do your thorough research before investing any money in it. This video is not at all an investment recommendation video, or neither am I providing any investment advice. Talk to your financial advisor before making any investment decision. It's just that I am thinking of multi-bagging in Trent Limited stocks in this dip. And on this note, this is it for today. Do let me know in the comment below how you liked the video. I'll be back in my next video soon. Till then, stay tuned and keep investing. Bye for now.